The year 2008 etched itself into history, a stark reminder of the interconnectedness of the global economy and the devastating consequences of its fragility. What began as tremors in the American housing market quickly escalated into a full-blown financial earthquake, sending shockwaves across the globe. From the towering skyscrapers of Wall Street to the quiet suburbs of Middle America, no corner of the world remained untouched by the crisis. Images of bustling trading floors, once symbols of economic prowess, were replaced by the grim reality of empty factories, shuttered businesses, and miles-long unemployment lines. The financial meltdown brought with it a wave of despair, wiping out savings, shattering dreams, and leaving millions grappling with the harsh realities of a shattered economy. The 2008 financial crisis was not merely an economic downturn. It was a societal crisis, shaking the very foundations of trust in institutions and exposing the deep-seated vulnerabilities of a system operating on borrowed time. The collapse served as a harsh wake-up call, forcing the world to confront the consequences of unchecked greed, reckless lending practices, and a systemic failure of regulation. This is the story of the 2008 financial crisis, a tale of unbridled ambition, catastrophic miscalculations, and the enduring struggle for recovery. It is a story that demands to be told, not just to understand the past, but to learn from its mistakes and chart a more secure and equitable financial future for generations to come. The seeds of the 2008 crisis were sown in the years preceding the collapse, a period often characterized by a deceptive sense of prosperity and economic optimism. The dawn of the new millennium witnessed a surge in global economic activity, fueled by technological advancements, expanding trade, and an influx of capital. In the United States, the housing market emerged as a particular bright spot, experiencing an unprecedented boom. Low interest rates, coupled with government incentives to promote homeownership, made mortgages more accessible than ever before. This led to a surge in demand, driving up housing prices at an unsustainable pace. Fueled by easy credit and the allure of quick profits, individuals and families alike were swept up in the frenzy of homeownership. Banks and mortgage lenders, eager to capitalize on the booming market, loosened their lending standards, offering loans to borrowers with poor credit histories and questionable financial stability. This era of seemingly boundless prosperity, however, was built upon a foundation of risk and unsustainable debt. Beneath the veneer of a thriving economy lay a complex web of interconnected financial instruments, opaque lending practices, and a dangerous disregard for risk, setting the stage for a financial reckoning of unprecedented proportions. The American housing market, once a symbol of stability, transformed into a speculative frenzy. Fueled by low interest rates and easy credit, home prices soared. Properties changed hands at a dizzying pace, seen as a surefire investment. The allure of homeownership reached a fever pitch. Driven by social pressure and rising values, budgets stretched thin. The dream of owning a home morphed into a speculative gamble. Media reports celebrated the housing bonanza, showcasing staggering profits. Headlines proclaimed a new economic era attainable for all. The message was clear: get in now or be left behind. This optimism masked a dangerous reality. Home prices weren't driven by rising incomes or population growth. Instead, speculation and loose lending fueled the rise. The housing market was transforming into a bubble poised to burst. The housing boom could not have reached such dizzying heights without the complicity of the financial industry. Banks and mortgage lenders, eager to capitalize on the seemingly insatiable demand for home loans, abandoned traditional lending standards in favor of a more relaxed and ultimately reckless approach. Borrowers with poor credit histories, limited income documentation, and minimal down payments were ushered through the mortgage approval process with alarming ease. These risky loans, known as subprime mortgages, were packaged and bundled into complex financial instruments known as mortgage-backed securities and collateralized debt obligations. These securities, marketed as low-risk investments with high returns, were sold to investors around the world, spreading the risk of the subprime mortgage market far beyond the borders of the United States. Adding to the complexity and opacity of the financial system were credit rating agencies entrusted with assessing the risk of these securities. Influenced by conflicts of interest and a desire to maintain their market share, these agencies bestowed AAA ratings, the highest possible investment grade, upon many of these toxic assets, misleading investors about the true extent of the risk they were assuming. The financial industry, fueled by a culture of greed and driven by the relentless pursuit of short-term profits, had engineered a system in which risk was obscured, accountability was elusive, and the seeds of a global financial crisis were being sown. The house of cards, built upon a foundation of subprime mortgages and complex financial engineering, stood precariously, vulnerable to the slightest tremor in the market. The allure of the American housing boom extended far beyond the borders of the United States. Flush with cash from export-driven economies and eager to diversify their investments, foreign investors, including sovereign wealth funds and pension funds, poured billions of dollars into the U.S. mortgage market, further inflating the housing bubble. Financial institutions around the world, eager to capitalize on the seemingly insatiable demand for high-yield investments, readily purchased mortgage-backed securities, often with little regard for the underlying risks. The global financial system, interconnected and interdependent, had become deeply entangled in the web of subprime lending, setting the stage for a crisis that would soon reverberate across the globe. Adding to the sense of complacency was the prevailing economic orthodoxy of the time, which held that markets were inherently self-correcting and that government intervention should be kept to a minimum. Regulators, influenced by this laissez-faire ideology, failed to adequately address the growing risks within the financial system, allowing the bubble to inflate unchecked. The world, blinded by a decade of economic prosperity and lulled into a false sense of security by the seemingly unstoppable rise of asset prices, failed to heed the warning signs. The seeds of complacency had taken root, setting the stage for a financial crisis of unprecedented magnitude, one that would expose the fragilities of the global financial system and challenge the very foundations of economic orthodoxy. At the heart of the 2008 crisis lay a ticking time bomb: subprime mortgages. These risky loans, given to borrowers with poor credit, fueled a housing bubble. Lenders, driven by rising home prices and demand for mortgage-backed securities, loosened standards. Low interest rates and aggressive marketing led many to take on unaffordable mortgages. When rates rose, defaults and foreclosures surged, triggering a global financial crisis. Securitization transformed subprime mortgages into global financial contagion. Banks offloaded risk, generating profits by bundling mortgages into securities. These were marketed as safe investments, but the underlying assets were poor quality. The complex structure and credit ratings obscured the true risk, leading to the 2008 financial crisis. Section 3. Deregulation: the watchdogs that didn't bark. The 2008 crisis was fueled by deregulation, dismantling safeguards from the Great Depression. Deregulation encouraged risk-taking and lax oversight. The repeal of the Glass-Steagall Act in 1999 blurred lines between commercial and investment banking. Derivatives like credit default swaps became tools for speculation. The lack of oversight in the derivatives market added systemic risk. Deregulation created an environment where greed and recklessness flourished. The watchdogs were muzzled, setting the stage for a financial crisis. Section 4. A house of cards built on debt and leverage. The 2008 financial crisis was driven by excessive debt and leverage. Leverage amplifies returns but also magnifies losses. Investment banks took on unprecedented debt levels. When the housing bubble burst, losses skyrocketed. The crisis highlighted the dangers of excessive leverage. It underscored the need for prudent risk management. The housing bubble deflates. By 2007, the housing market began to strain. Home prices faltered, leading to a decline. The Federal Reserve raised interest rates, adjustable rate mortgages reset higher, demand waned, prices dropped. New homes sat empty. The bubble burst, with devastating consequences. As home prices began their descent, the foundation of the financial system, built upon a mountain of subprime mortgages, began to crumble. Borrowers, faced with rising mortgage payments and declining home values, found themselves underwater on their loans, owing more than their homes were worth. Defaults and foreclosures, once a rarity, became commonplace, sweeping across the nation like a tidal wave. The wave of defaults had a devastating ripple effect throughout the financial system. Mortgage-backed securities and collateralized debt obligations, those complex financial instruments that had been marketed as low-risk investments, plummeted in value as the underlying mortgages defaulted. Investors who had poured billions into these securities saw their portfolios decimated, their confidence in the financial system shaken to its core. The crisis soon spread beyond the confines of the mortgage market, infecting other sectors of the economy. Banks, saddled with billions in losses on mortgage-related assets, became reluctant to lend, fearing further defaults. This credit crunch rippled through the economy, stifling business investment, slowing consumer spending, and exacerbating the downturn. Fear and panic gripped the financial markets. Stock prices plummeted as investors, uncertain about the extent of the damage, rushed to sell their holdings. Credit markets froze as banks, distrustful of one another's solvency, refused to lend even to each other. The global financial system, interconnected and interdependent, teetered on the brink of collapse. On September 15, 2008, Lehman Brothers filed for bankruptcy, sending shockwaves through the global financial system. Lehman's collapse marked a turning point in the crisis, leading to unprecedented turmoil. The bank's heavy investment in risky assets and mortgage-backed securities proved disastrous. The US government chose not to rescue Lehman, fearing moral hazard. Lehman's collapse sent a chilling message. No institution was immune. The 2008 financial crisis began in the US but quickly spread globally, affecting banks, markets, and economies worldwide. European banks faced staggering losses, triggering a sovereign debt crisis. Emerging markets experienced sharp slowdowns as demand for exports plummeted. The crisis exposed the fragility of global financial systems. The interconnectedness of the global financial system transmitted the crisis rapidly. The crisis highlighted systemic risks in a globalized economy. It was a wake-up call exposing weaknesses in the financial system. The crisis led to prolonged slow growth and high unemployment. It forced a rethinking of financial regulation and risk management. The lessons learned would shape the future of global finance. Emergency measures, a global scramble to avert collapse. As the financial crisis spiraled out of control, governments and central banks faced unprecedented challenges. The interconnected global financial system meant inaction could trigger a domino effect, leading to a complete meltdown. In the US, the Federal Reserve, led by Ben Bernanke, took unprecedented steps to stabilize the system. Traditional monetary tools were insufficient, so the Fed injected trillions into the financial system. These interventions aimed to restore confidence in the financial system. The bailout dilemma: saving the system or rewarding recklessness. As the crisis deepened, governments faced a dilemma: save failing financial institutions with taxpayer money or let them fail. This sparked intense debate and public outrage. The Bush administration passed a $700 billion bailout package, TARP, to stabilize the financial system. The TARP bailouts were met with public anger and seen as favoring the wealthy. The moral hazard of future bailouts, encouraging risk-taking, became a central concern. A glimmer of hope, stabilization, and the long road to recovery. The combined efforts of central banks and governments succeeded in averting a complete financial meltdown. By early 2009, the financial system showed tentative signs of stabilization. Stock markets staged a cautious rebound, reflecting a belief that the worst might be over. The real economy faced a long and arduous road to recovery. The 2008 financial crisis cast a long shadow, shaping lives globally. Governments averted a meltdown, but recovery was uneven. The recession was the worst since the Great Depression. Unemployment soared, businesses closed, and families lost homes. The social fabric frayed under economic strain. Recovery was slow and uneven, with widening inequality. The crisis fueled populism and anti-establishment sentiment. Trust in institutions eroded, exposing global fault lines. The 2008 financial crisis exposed weaknesses in the global financial system, prompting regulatory reforms. These reforms have not eliminated risks in a complex global economy. The Dodd-Frank Act and Basel III aimed to strengthen oversight and reduce systemic risks. Despite these efforts, the financial system remains vulnerable to shocks and imbalances. The rise of shadow banking poses new challenges to regulators. The interconnected global economy can rapidly transmit shocks, as seen during COVID-19. Vigilance and adaptation are crucial to balancing financial innovation and stability. More than a decade after the financial crisis of 2008, the world continues to grapple with its legacy. While reforms have been implemented, vulnerabilities remain. Have we done enough to prevent a similar crisis? The Dodd-Frank Act and Basel III represent significant steps, but face criticism. Creating a culture of responsible risk management requires more than just rules. Preserving the memory of 2008 is essential to building a resilient future. The 2008 financial crisis was a stark reminder of our interconnected world where risks spread rapidly. The COVID-19 pandemic highlighted global economic interconnectedness and supply chain fragility. Climate change poses systemic risks requiring significant investment and cooperation. Building resilience means embracing innovation and long-term value creation. The legacy of 2008 should inspire a more resilient, equitable, and sustainable future.